Hey, hi guys, how are you? Hope you're well. My name is Bryan Rukenya, and I'm back again. I had promised you I'll be back with just a small topic. Personally, I'm a finance advisor, and so I come in to talk about something interesting that has been online. And I thought, though it's been handled in different ways, they still need to shed more. And my topic today I'm talking about money market, MMFs, and I'm also talking about education funds, education policies. And I'll start by just saying that I know it's happened that there's so much talk about it, where some people have been handling it in this way that they put one over the other, that one is better than the other, that this one, you take this one, is much, much better than this one, that this one is not supposed to be used this way, but this one should be this way, and that the one is better than the other. Let me confess. Number one, money markets is a very beautiful vehicle. Number two, education policy is a very beautiful vehicle. Okay. Now, I know, even in our finance planning and goal setting and all that, you know what kind of temperament you are, what kind of a person you are when it comes to something called savings. Okay. I know there's between the savings, there's two people. Number one, the disciplined saver. Number two, the undisciplined saver. Okay, so let's consider all this. So here you are, very disciplined in saving. You put a goal down there, you put a goal for this long, and you actually achieve it, and you've done it not once, not twice, not three times. You always achieve your goals, regardless of whether they're short-term, long-term, or mid-term. You have a goal, you put a saving every month, and even if you get a call from, I don't know from which mass, you never touch that money. That's a person I'm calling a disciplined saver. Okay. Then there's this person. Yes, the intention is very good. They know that, number one, I pay myself first, and I know that I put aside a savings. This is the intention, eh? So remember, this is just an intention. I know I look at my finances, I get a salary at the end of the month, or I get an income at the end of the month, or anyway in the part of the month, and I know that I'll save 50% of it, or even 60% of it, and this is has a goal at the end. Eh? Probably the goal at the end is to buy a portfolio, to buy of investments or that. Eh? So this person has good intentions. But you surprise, you find him after 3 months, ask him to show you his balance, his saving portfolio, and they'll be embarrassed because what you'll find there is either 48 shillings. Yeah, you'll find 48 shillings, 75 bob. You wonder what was happening. You had such fire and vigor when you're talking about savings. What happened? And they tell you, man, I don't know what really happens. And then you find this guy goes all the way to 40 years of age. They still have no finance, no savings at all. Yeah? So these are the two people I'm talking about. Number one, the disciplined saver. And two, the indisciplined saver. Both are savers, but both are informed by their discipline. So now let's address this issue, money market versus education policy. All right. Number one, both vehicles are saving vehicles. I mean, you cannot have a portfolio you don't have a saving in there. You have a zero balance in your MMF, you have a zero savings. You have not started the education policy, don't have one, you don't have a saving policy, you don't have a saving plan. So both of them are saving plans. Why it feels sometimes like, why do you have to think that sometimes education plan is a waste of time Why do you have to think that way? That money is your money. It's your money. It's yours. It's not for the insurer. It's yours. If you get to time, you'll be paid your money plus all the bonuses it has earned. It is your money. It has grown and did not stagnate, number one. Never did it deteriorate or depreciate. It actually appreciated. Because what you put in there is not what you'll get out. Okay, so now this is all your money. The one is in MMF is your money. If you do the MMF way, it's your money. The one you do in education plan, it's still your money. Okay. All right, so let's talk about the money market. What is money market? Money market fund, interesting fund. Some will yield, depending on which company you go to, some will yield 13%, 14%, others 12%, others 9%, others 8%, 6%, depending on where you go. Money market fund is a saving vehicle. Yes, it is a saving vehicle that addresses ideally short-term, mostly short-term, and I'll say that word mostly because it's mostly short-term and partly mid-term. Leave it not really long-term, mostly it's short-term and mid-term. Why am I saying that? Because this is where you open a money market fund, you put your savings per month, which is number one. You can take it to you can put either your emergency fund in there or your contingent fund in there. Yeah. So why are you talking about emergency and contingency? Emergency fund is with the fund where you put money every month to grow to grow our savings. And you keep saving and keep saving. And then a friend of yours, a relative, tells you, I'm relocating out of the country. And my motorbike, I bought it for 3 million. If you only have 600,000, I'll take it. I'll give it to you. Then you remember you had savings worth 600,000 in your MMF in the emergency fund. You will have, then you are also a bike enthusiast, and then this is an opportunity that has just presented itself, and it's a one in a lifetime. If it passes you, you have missed it. Ideally, I'm just giving one of the ideals. Maybe you're not a motorbike person. Maybe you're a business person. I know of a business of a friend of mine who used to be called. They used to courier medicine, drugs. So is it courier? What they call it? What they call it? Not courier. It's couriering. Because she used to be called get a call, and she's told, well, I have the goods here. Come for it now. If you don't come now, it's going to the next person. You missed it. So this person, number one, she was in the office, employed. And now she's trying to get space where she can run to get this commodity. And then the commodity was about 700,000. So can you imagine, she has a money market fund, yeah? And that's where she can put that 700,000. And it's an emergency. There'll be a disclaimer, because you see, money markets, you can only access your higher amounts after 3 or 4 working days. So let's consider that when you're withdrawing and it's high figures, you have to give them 4 working days. So yeah, probably therefore the motorbike would work, because you'll tell this guy, give me 4 days, and then you give them the 600,000, and the bike becomes yours. So that's an emergency fund. What of a contingent fund? So you see, this emergency, let me go back. Emergency fund, if it's an emergency, it's wherever it happens. It could be today, it could be in 3 months, it can be in 6 months, wherever the emergency happens. So it could be you're having a mind here of short-term, mid-term. You're not expecting an emergency. If it's 1 year past, or 10, 5, 6 years, it was never an emergency. You had a chance to save all that time. This emergency is what I'm calling emergency fund. My fence has all been flattened by floods. Yeah. You have to break that account. Yeah. And sort out the fence. That's interesting. So yeah, so that's an emergency fund. Number two, the contingency funds. Contingency fund is where you know your monthly expenditure, and you need to. The experts say, some say will say 3 months, some will say 6 months, equal to that amount, equal to six times your monthly income, 6 times it, so that stays in your account, in your money market account. Probably you want to put, if it's a whole 100%, you put 40% in a bank account, and then 60% in the money market account. This is a fund which, even if, what happens? What is the most emergency you think of? Which one is the most one? Who broke a leg? Your daughter, your son?
Yeah, Actually, I wanted to ask you why you're not talking about, when you talk about emergencies, you're not talking about medical emergencies. Where does that fall?
Yeah. So emergency funds, the first one, the emergency funds now answer as that. The fence, talking about the fence, the motorbike, a member of the family needs immediate medical attendance.
What about when somebody passes away? Is that an emergency? Do you break
Yes, it's also an emergency.
It's also, yeah?
Yeah, because you need to raise some funds. And you always know that you had a fund which is for emergency. That applies. Now the contingency funds is different. This is when now it's 6 months worth of your pay, monthly pay, 6 times. This one now, the roof has fallen on your head. You don't even touch it. What else can you think is an emergency? Somebody has broken a leg, your daughter.
The house is flooded, you need to move.
You don't touch it. You don't even think it's there.
So where do you get money? Do you then take a loan?
You should have both accounts, emergency and a contingent.
So if my house is flooded and I need to move immediately, then that's an emergency.
Emergency fund.
Okay. What if I've exhausted the emergency fund?
You try to look for elsewhere where to get money.
Can I use my savings
Contingent?
for the holiday?
Yes, because now you use it to the intention of replenishing it. Yes, you use it, but you have an intention. The next money you're getting, you're taking it back to that. But the contingent, you cannot touch it. It is no option for you to. There'll be no option for you to catch up again. Yeah, you don't touch it. Why? This is why I'm saying this. This is a fund where everything, once things happen in life, you lose your daily job, you're sustaining your daily bread job. It goes. The company has closed down. The company has run bankrupt, and you guys have been sent home. You need to have to survive for the next 6 months without changing your lifestyle. You need to, without changing your lifestyle.
So I don't need to downsize.
You don't need to downsize. You don't need to take your children to a cheaper school. It's for 6 good months. As you are planning for the next phase of your life, maybe you start chasing other jobs.
Where does illness now to the person who is saving, if I just happen to be ill for a long time and removed from the payroll, or I get a medical condition that I can no longer work,
then that's also a termination. So it will also be a termination, meaning there's no daily bread. Then the contingency funds now keeps you for 6 months, but you still need to seek for medical.
Yeah,
you still use the contingency fund. That's for 6 months, but of course it will now deplete more of your money. Yeah.
Is any of the insurance packages that are available in the market going to help me now after the 6 months? Is there any, like when we talk about life insurances, is there an insurance that is able to cover me for the rest of my life after 6 months? Maybe my leg has been amputated, or my hand, or I've gotten
for the
whatever.
No, we're taking me to not to the topic to somewhere else.
I'm just trying to look up for my survival here.
For your education plan, okay? Because that's what I'm talking about. Or your endowment plans, or your whole of life, or your VA, value added term. Value added term and whole of life are purely protection. So you pay. It has a sum. It has a protection figure, and I'm interested in that these two vehicles, the value added term and the whole of life, you save little, but you get, when you, in case of demise, so much, extremely big figures. I know the presentation was 5,000 for a lady who's 35 years. They get 5 million.
5,000 was the contribution?
For 10 years, yes.
Okay.
For 10 years, how much will you have saved? 600,000. But if you die, it gives you 5 million.
What if I am amputated my legs, my hands?
Now, so that's the cap, that's the protection part. But it still has riders on it. You can add a rider. Okay. So the rider, there are four of them or five. Accidental death, they double the sum assured. The protection amount, they double it. Accidental death, so your people are given twice.
So instead of 5 million, they're given 10 million.
Yes, 10 million. And it, but so when you tick that accidental death, there's an extra amount it adds to the policy amount. Okay. So
my contribution,
that 5K, remember that 5K that gives you 5 million? You'll add close to about another 1,000 and something.
For the rider.
That's a rider. Accidental death. Then there is permanent disability.
Yeah, that's the word.
Permanent disability. Or again, it can double it again, another 5 million. Okay. So the permanent disability, and then there's another one called critical illness.
Yeah.
Which now, for the plans that are there, you can find a plan that gives you 19 illnesses that they cover, all the way to arthritis. And depending on how much is your sum assured, how much is your protection, you can equal the amount of that amount, actually up to 15 million. Up to 15 million.
So that's the cap.
Yes.
Is it given upfront or?
Yes, once the doctor says critical illness, you go to the hospital with 15 million in your pocket. You'll even get healed faster.
On your way home.
On your way home, you get healed. Yeah. So you have 15 million in your pocket, and your cover is still running. If you die, the 15 million will again be paid.
Twice.
Yes, at death. That's not the rider is not the cover.
Rider
is just a protection. So this is
what you're talking about, the rider.
Yeah.
So now I've gotten a critical illness.
Yeah.
I'm paid 15 million.
Yes, as the cover still runs.
As the cover is running. Am I paying?
Yes, you're paying. You're paying the cover.
Okay, I'm paying.
Unless there's also down there another figure you can add called waiver or premium. Okay. So your critical illness, you got a critical illness. It has made you permanently disabled.
Yeah.
How many times are you paid?
Twice.
Yes, you'll be paid for critical illness, and then you'll pay again for permanent disability. And then you have you've chosen to add a few more thousands for waiver or premium.
So that when I get critically ill
or permanent disabled, you can't work.
Yes.
Now the company starts paying for you.
Until maturity.
Until maturity for the value added term. Or until death for the whole of life. But so the whole of life, you can how it works. You contribute for 10 or it is from 10 to 15 or 20 years. That's a cap, 20 years. And then at the 10th, 20th or 15th year or the 10th year, depending on what you put as your maturity, you stop paying, but it keeps running. The cover keeps running until you die. So that money you'll never enjoy. It's not for you. It's like how you move inheritance to the next generation. You're moving your wealth to the next generation because it pays at death only. only.
So that one is which one?
Whole of life.
Whole of life.
So you pay for 10 years and you stop paying. Yeah, so you start now at 50. At 50, you pay up to 60. And then 60, you live for another 60 years. You'll be undercover but not paying anything. If anything happens to you, then you die. That's when the next of kin will be paid. Again, should also, this is a disclaimer, critical illness, permanent disability, they expire at 70.
What does that mean?
So if you don't get ill at 70, up to 70, it expires.
Oh, so I don't benefit.
You don't benefit.
Do I get my money back?
No. My riders are riders even is not considered as part of the investment. It's just something you are enjoying when you are living.
Okay.
Yes.
So now I'm here thinking, I know this is not part of what you had prepared to speak on, but I'm here as a client and hearing you speak, I'm thinking, what if my partner knows all this and they make me permanently disabled so that, we can get 15 million? What if I plan together with my spouse, break my leg?
Somebody was saying, there's always that one blood that never dries, the drop of blood that never dries. In the crime, scene of crime. There's always that one drop that never dries.
So there's always evidence.
There'll be evidence. And I'm telling you, when the investigator gets into business.
So are you saying that when I go to claim for my, what's the word? When I go to claim.
You make a claim.
When I make a claim.
There happens to be a claim.
Yes.
Somebody needs to quantify, the doctor needs to quantify that actually this quantification, if it's out of permanent disability, out of accident.
Yeah.
They have to quantify that it was out of accident and you're permanently disabled. What if, because there are people who have rolled their own rolly. Yeah, they've rolled their own lorry so that they can be paid. And it was captured. They were not paid. When the investigator gets into, if they smell foul play, there'll be foul play. And they'll assure you they'll get it. Somebody will miss a statement. Because it has to be quantified by the police. Yeah? All that.
There's no way this person can pay up people to give false testimonies so that they can get paid. They know they're going to get 15 million.
The problem is when the next person you always add, you're adding more baggage and you're adding more possibilities of you being caught. This one person might wake up that day and forget exactly what you guys told him. Somewhere, this person, the other person you just added, may not have the heaviness that you guys have. Somewhere, he'll just lax and be careless with his words. There are people who are caught on the line, banking hall, as they line up to collect the money. It's already been paid to them. And as they started arguing in the queue. And so this person who's behind them, they don't know who he is, was one of the people who were handling his case in the insurance company. Handling this case. And he hears this talk and he runs back to the office. Those people, consider them. Do you know they are now they're incarcerated.
So you're saying that insurance fraud, I can be arrested and put in prison?
They're in prison. They've killed, you kill somebody, yeah? It's murder.
Killed.
Yeah, it's murder. Yeah.
So, okay. Maybe my questions have run out.
So that's that's where the insurance comes. That's what I was getting at when I was talking about MMF versus education plan. Is that one of them offers protection, the other one doesn't.
So the education plan offers protection. MMF does not offer protection. So it's just savings.
It's just savings.
Savings only.
Yes.
Okay. Meaning, so that's why you're saying it's need-based.
Yes.
So what do you need?
What do
you need
really
protection
need?
Or do you need to save?
It's for short term.
Okay.
Anything short term when market would work. Yeah. Yeah. And then I always say, and this is just my conviction, that remember, why is it an insurance company? per se not an investment company. Okay. People who argue this two between the money market and the education thing, they always argue it from the investment part. An insurer is not an investor. What happened is that in the previous years, the protection amount was so higher, was particularly high than in case you maturity figure. In case you go without any harm to the end of the policy, the protection needs to be very high. Okay. So you find, because you not to gain from the death claim or from the protection, you wonder what were you doing in that plan, because it gives you so much, just little. So you feel like you just took a walk. But now there are companies which have realized it came with when people now they realize they don't handle so much death claims. So most people are getting to maturity. So they are trying to see, well, how can this person who's getting to maturity also gain? So some companies decided to lower the sum assured, the protection, and raise the investment. So it now becomes a hybrid where there's a protection, which is the work of the insurer. Why there are insurance companies to offer protection. That's their core. The core is not investment. The core is to show that they're a protector. But now they understand this person lives to term and they did not get the protection kicking in. But they enjoyed that protection all along, because if anything had happened, they still could have been paid their protection. So they enjoyed it. But now they feel this person still gets to maturity, but they don't feel why they were in that vehicle. So they lowered this protection and raised the investment. And now when you get to term, you will see your money grew. Yes, now you'll feel, I didn't take just a walk. My money grew. And that's why I tell people, you have your money markets, have your investment portfolio, have your Mansa X, have your shares, have your real estates, have all that. Let it give you a figure. How much is your investment portfolio? After having that figure, consider then a protection equal to that amount. Why am I saying that? Is when you find this person has an investment of 15 million portfolio. They get only one illness, that their family has to sell all these investments. 15 million, they put it into the critical illness, and this guy ends up where he was starting. What if he had a protection? That whole of life, critical illness of 15 million. Get?
Yeah.
They'll be paid the 15 million as the portfolio is still protected. Yeah. So that's why I always say there's no saying that money market and comparing the two. They are both important. They're totally both important.
Can I choose one?
You can choose one, but don't miss the other. If you are in serious financial planning, don't miss the other.
Is financial planning only for the people who have a big paycheck?
A big paycheck? No, it's
Can
not.
a Joe Kali guy, a Mama Mboga be able to get into
investments?
The
plans, the investments. It's interesting. Do you know how much 1,000 bob can buy you in shares? 1,000, this is 1,000 shillings, can buy you 100 units in Safaricom. What if you buy that monthly for the next 5 years? Do you think after 5 good years, you'll have more than even 20,000? I don't know. I'm just giving a figure. Or shares, just 1,000 shillings. Not only in Safaricom, even you go to E-rates. E-rates are beautiful vehicles. These homes we see, Quetu homes and for the hostels. You buy into a share of it. For 100 shares is about 2,000 bob. Is it about 1,400? Yeah, 100 shares. So you see, it's for everyone. And how do you do that? If you're told the education plan costs the lowest figure is 2,000 bob a month, how do you work on that if you're a Mama Mboga? Break it down in daily activity. That simply means 66 shillings a day. For 30 days, you have a 2,000 plan. Yeah. It's doable for anyone. Yeah. The cost of insurance has come really down to allow anyone can take it. Yeah. Yeah. So the discipline will be for you to save for the next 10 years or 8 years for the education plan, the shortest term. Yeah. That will be the discipline. Yeah. So it is, yes, it's viable. And then the person let's say the person who says, I have so much loans I'm paying, I'm paying, that's the best person to take up a plan. Why? Because even as you pay your loans and your pay slip is depleted, there's always that waste we have. Do you know there's always that waste we have in our budgets? Do you know there's a waste in a day? When you wake up in the morning, you buy that 100 shillings bread and a cup of milk, 150. You spend 150. Do you know you can buy a smaller bread of 60 bob? That's true. So you keep 40 bob and you keep it aside. Go down the day. Maybe one meal a guy, 1 or 2 meals a guy. The evening meal, yeah, you're buying mama mboga, you're buying 30 bob. Why don't you buy 20 bob that day? Yeah. You go ahead and you have a cup of tea with a friend. Yeah. Today you have it with a snack. Why don't you reduce two mandazi to 1 mandazi? The 60 bob will come automatically just by minimizing the waste. The 60 bob will be found even if you're paying a loan. Does that not mean because you're paying a loan, you're not eating, you're not showering, you're not taking buses, matatus, you're not calling, and you're still paying a loan. So you can still try somewhere to minimize the wastages, and you buy yourself a plan. The best person to save is a person who's paying loans, because they're told to pay towards a bigger amount, but pay slowly at this time. Pay little by little. You're told pay 2,000 bob for the next 10 years. Vis-a-vis you're told give us 200,000, and you're paying a loan. Where do you get the 200,000? So you do the 2,000 is doable for you for the next 10 years. And your loan will have been paid, and then you continue paying the education plan. So yes, we always feel with the client. Sometimes you feel the client is telling you, I have so much loans I'm paying school fees, I don't know, I have so much expenses. No, let's not allow ourselves to be stuck in today while you know tomorrow is coming and we're not prepared for tomorrow. Because all these plans are for tomorrow. Yeah. So yes, very important vehicles. Money market, education plan, both are important. So when you talk about money market, you're talking about contingent, you're talking about emergencies. Yeah, very important. When you talk about education plans and the endowment plans, you're talking about protection, and you're talking about your savings discipline. Thank you.
Oh.
Yeah.
I'm so ready. I'm like, I thought you had more. I know you have more,
Yeah.
but you had planned, you said to us that it was going to be a short one
Yeah,
today.
short one, yeah. Basically for me, I know. To me, it's very passionate when you tell me about education plans. It answers a lot. It answers, especially for those people who have gone to maturity. They've gotten to maturity. They'll always buy another one because they saw the importance of it. And the problem with the money market, the money market is a very good vehicle if you're disciplined. And if you're disciplined and you got the 10 years without removing, you'll double your money than what you'll have got in the education plan. That's very true. That's very true. That's very true. Very true. But the discipline should be there. How many of us are disciplined? How many of us are disciplined? That's a question. And if you've not known how your discipline is, put me to the test. Go open a money market account. Let's talk about it in 2 years' time. And you should open me your account and tell me what you have in that account. Yeah, so yeah, discipline. Thank you.
Wow. Is there a way people can get in touch with you if they want to discuss this further?
Yes, sure. My number 0720 735 795. Again, that is 0720 735 795. Thank you. Bryan Rukenya, being your host today.